Every show, we try to get an expert in to help you learn about the tools that you need to get a little further in retirement. So joining me now, CFP Chad Burton, to talk a little exchange-traded funds. What are they and why do we care, Mr. Burton?
Well, ETFs are one of the fastest growing financial products, and it's really kind of been revolutionary because it's allowed investors to get into the market at a cost of probably about a tenth of what investing costs when I got into the business almost 20 years ago. So ETFs are mutual funds that trade like stocks. And what that allows you to do is when you buy a mutual fund, Rob, if you buy it in the morning or if you buy it late in the day, you don't get the price until the end of the day. So if you sell it in the morning, you don't get the price till the end of the day. ETFs trade all day long like stocks. So if you sell it right now, you get whatever price is going. If you buy it right now, you get whatever price it's going for. So they're very similar to mutual funds, but they're also known for lower fees, and they're also known for much more tax efficiency in many cases.
Let's pull up a graphic and see what it has to say about exchange-traded funds. Most are index funds that trade like stocks. They're known for lower fees and reputation for being tax efficient. That lower fees, why is that important, Chad?
Well, when I got into the business, even no-load funds, the average fee was around 1 to 1.5%. And now ETFs, because of the way that they're traded, technology and everything else, a lot of them are about a tenth of 1% or less. So it allows people to get a broad shot into the market. You can look for S&P 500 funds like SPY, QQQ, get you the NASDAQ. Other products get you the whole stock market with one shot at a tenth of a percent or less per year. So it allows investors, like I said, to start building wealth at a very, very low cost.
Some of the things that people need to be aware of is to be successful, it takes time, it takes low costs, it takes rebalancing and sector discipline. This one, consider ETFs for low cost exposure, for large cap, consider it for cost exposure to US mid cap, consider ETFs for cost exposure, low cost exposure to specific sectors. Let's talk the first one, large cap. Why is that?
Well, here's the deal. Is most mutual fund managers, most managed mutual funds, about 90 to 93% of them can't beat their benchmarks. They can't beat the S&P 500. So where I like to use ETFs is I like individual stocks, I like no-load funds, and I like ETFs. They all have their place in a portfolio, and I think most investors are better served if they use index funds or ETFs in the large cap space or the mid-cap space. But if I'm going overseas, if I invest in international developed markets or international small caps, international emerging markets, I want a manager there with boots on the ground that knows the political system, knows the currency issues, and an index fund isn't smart enough to invest in international, in my opinion. It's easier to find a managed mutual fund that can beat the international indexes, or a managed mutual fund that can beat the even domestic small cap. So where I like to use ETFs, Rob, are large cap US, mid cap US, but most other places I still like to either use individual stocks or managed mutual funds.
Now you talked about tax deficiency, but we kind of skipped right over tax efficiency. Give me a little bit more color on how ETFs play into that.
Sure. Since most ETFs are like index funds, they really only change the stocks that are inside them once a year. So they're known to be tax efficient. There's not a lot of turnover. There's not a lot of stocks going in and out creating a tax bill. So if you're a person that's gone beyond maxing out your 401k, doing the Roth IRA, and you're starting to try to build a portfolio outside of those accounts, you have to be tax efficient. The right assets to put in tax efficient accounts are typically large cap, mid-cap index or ETFs, and then tax-free bonds in many cases. So where they really fit in is in a tax-efficient portfolio.
So when should ETFs be avoided?
ETFs should be avoided if you're trying to invest in your taxable account. There's a lot of new ETFs hitting the market that are actually managed, where they change stocks almost once a quarter. So what you want to do is you want to avoid ETFs if they're brand new. Have them out there for at least 6 months. Don't touch them for the first 6 months because there might be trading errors or pricing errors. There needs to be more volume. So avoid ETFs when they're new. Avoid ETFs if they have a lot of turnover.
Let's pull up that final graphic and see what that has to say about ETFs. So international, consider managed no-load mutual funds for international. You hit that pretty good. Emerging markets and small cap. Why do you not do ETFs for international? Give me that one more time.
Because a lot of the international funds or international indexes that we see out there are either too broad or almost too dumb. They own the largest of the large, which aren't necessarily the stocks that you want to own. International, what's so attractive is the emerging middle class, and that's the types of stocks that you want to invest in versus these large companies that are part of the index. It's just not smart enough. International investing takes a little bit more turnover, a little bit more active investing versus an index that just changes once per year.
Let's pull up CFP Chad Burton's contact information. You can find him at newfocusfinancial.com. That's newfocusfinancial.com, and the phone number 888-762-2423. That's 888-762-2423. Now, to get your calls on this show, pick up the phone. Call me 415-561-8753. That's 561-8753. We'll take a break. We'll be right back. Welcome back in. Rob Black, Your Money. I'm Rob Black, talking all things financial. Don't forget, this is your show. You can call in 415-561-8753 and or drop me an email, rob@robblack.com. It's rob@robblack.com. But joining me now, once again, CFP Chad Burton. Chad is a financial planner. Chad, there used to be a rule of thumb, something about 4%. What did that apply to as far as retirees?
Well, what that applied to is that if you retire at about 65 and you've got a portfolio that's well balanced, that if you draw about 4%, if you can afford to live off of about 4% starting at age 65, you're going to be able to adjust that upward with inflation each year and have enough money to live till about age 95 to 100. So there's several issues, though, that are challenging that rule as we go through this economic environment.
Now, some of those created when interest rates and bonds were obviously with higher rates of returns. Right now we're in that low rate of return for bonds and CDs. Right. What else do we need to know?
Well, yeah, I mean, interest rates on CDs and bonds were cut nearly in half since 2007 with what central banks are doing. So investors, they need to have at least 3 years worth of portfolio draws in cash. They need to have usually about 30 to 40% of their portfolio minimum in fixed income. So that's a significant portion of a portfolio. That's all changed. So several other reasons why that's challenging is that rule kind of became popular in the 90s, Rob, and back then interest rates were higher. It's also, you've got to be a little bit smarter about your retirement spending and your projections, because spending is not in a straight line in retirement. I often see people spend more the first 4 or 5 years of retirement because they're doing the honey-do list or the bucket list, things they always wanted to do they didn't have time to do when they were working, the second home, the RV. And then later in your 80s, you might spend less. You might not travel as much. So spending isn't a straight line. You can't just assume it's correct. If you're going to go into retirement, you're going to stop funding your nest egg. You're now going to live off of your nest egg. So your cash flow projections have to be extremely accurate, and you have to keep an eye on them.
What's a better way to go out and plan for expenses in retirement? Because quite honestly, I'm 20 years away, and I don't even know what my expenses are going to be in 20 years.
Yeah, and what you have to do is constantly track your expenses. I'm not saying you live off of a budget. There's some people that live off of a certain amount of cash in an envelope. I'm not saying you do that, especially if you're a wealthy person, but you do need to track your expenses to say, here's what I've spent last quarter, and so you know what's going to be there in retirement, and continue to track that. But you also have to put in things like, hey, you're going to need a new car every 10 years or so. You're going to have to set aside a certain amount of maintenance for your home, because what if you need a new roof on your house in, say, 15 years? And also, what about your kids? Your kids are going to college right now, potentially, but youth unemployment is very high right now. So there's a lot of kids coming out of college still staying with their parents, and that's causing a bit of a drain on the budget. So you have to line out your cash flow items. You have to say, oh, here's my expenses for vacation for maybe the first 15 years of retirement, but it might not be the case in the last 15 years of retirement. So you really have to project that out with your earnings and have a detailed written cash flow plan and say, where is each dollar going to come from? I've got retirement accounts, I've got taxable accounts, I've got my cash. Where is each dollar going to come from as I go into retirement?
I've got a 75-year-old relative that recently bought a new car. I was like, go ahead. You're not going to live forever. With that said, there's no right answer. How do we know when we can start spending our money down? How do we know what the time is right?
Well, for one thing, too, you've got to set aside a certain amount of either a lump sum or get a long-term care insurance policy if you're kind of the middle-class American, because a long-term care stay, when somebody's, gets to the age of 75, 60% chance that you're going to spend some time in a nursing home. So you need to have a plan for that. What is the plan for that? Are you going to use an insurance policy? Are you going to tap the equity in your house, or do you have set aside a certain amount of money? But after that, you really have to be clear on what you want to spend and whether or not you have enough.
Let's pull up his contact information once more. CFP Chad Burton. You can find him online at newfocusfinancial.com. That's newfocusfinancial.com. He's also got an 800 number, but it's 888-762-2423. That's 888-762-2423. That's CFP Chad Burton.
The news and views expressed on this program are not necessarily those of Cron TV, its management, or advertisers. Consult a broker or advisor before taking any action on the stocks mentioned on this program.